With over 23 years of experience in the stock market, this is Anthony with Simplified Profits. Today, we're going to go over 8 really important points to build wealth and keep things simple. These are things I've picked up over the years, but something I wish somebody would have taught me when I was very, very young. So, we're going to first dig into a compound interest calculator. And the first point, all right, this is point 1. Your income is your greatest tool to build wealth. Okay. If you haven't read The Richest Man in Babylon, pick it up. There's a ton of Dave Ramsey stuff out there. There's a ton of stuff that will help you understand putting a percentage of your money to work. Okay. You should bare minimum 10%, preferably 20% or more. Okay. So this is what we started our transparent account with. Okay. The principal amount was $2,000 that came from our income. We deposit roughly we deposit 20% of our income into that account, which roughly is an average of about $1,400 a month. And we're just going to look at the 12-month period for hitting these goals in 1 year at 84%. So our goal is 7% a month minimum. Okay, that's just our goal. We may do lower, we may do more. We were on an 11% a month average up until really last week, which I haven't really updated that on the transparent account, which I'll shoot a video out. I ain't got much time today after this video, but right now we're about 25%. So we need about 3% more this month to hit it, which I'm sure we will. But April 1st made us look like a fool. Beginning of April, we broke some rules that we shouldn't have. Okay. We should have just stuck with what's in Simplified Profits, the book, but we didn't. And we went ahead and locked in some losses, which I hate doing, but there's some crazy things going on around the world. And we'll talk about that a little later. Plus the market's at all-time highs, but let's get back to our point. Okay. So we're using our income and we're trying to compound 7% a month. And this is what that equates to in 12 months. Okay. So roughly we would put in 18,000, we would make 12. That would bring our maturity value to 31,000. Now let's take that. Let's go 3 years. Let's say if we continue that for 3 years, which you should be able to, if you learn these principles, this should be something you should be able to do every year. It's very simple. But so in 3 years, total principal, 52,000, and interest amount, which is our profits, 193,000, and maturity value, 245,000. Let's take that to 6 years. I'm sorry, 5 years. And you can see that equates to 1.3 million. Make sure you pay your taxes on that, which is something I just got done filing. I hate paying the government more than they even take from me throughout the year, but especially when it's going to Ukraine and illegal immigrants, but that's another topic. Okay, but now let's take this monthly deposit out. Okay, let's say we just started with 2,000. We're doing 7% a month, and we're not even putting anything else in there. Right now it's at 1.3. Let's calculate it. It's down to 115,000. Okay, so you can see the difference from keeping money flowing into that account to watch it grow versus just using that original 2,000, trying to get 7% a month. It's going to grow much slower. Still great return, but it's much, much slower. So if you can use your income to get continually to put into that account, it's going to grow a lot quicker. And let's just for fun, let's do this for 120 months, 10 years, looking at $78 million. Now, that rate may slow down when you get up there. Usually we handle our account as if we would. It's $1 million account, right? We don't go all the way in on positions. We want to make sure we can scale into that position multiple times. So right now we're trading our account like it's $1 million account. So, but I ain't talking about 7 figures. I'm talking about 8 figures. Once you get into that double digit millions, might slow down just a little bit, but keep in mind your income. If you learn you a skill set, I don't know what you do for a living, obviously, because I don't know who's listening to this, but get you a source of income. Get out there, work, use that money, and put it to work for you. Okay, because it's gonna increase your chances of becoming wealthy by a ton. Okay, you can't just hope for the best. You can't just take $1,000, put it in the market, and hope to be a millionaire overnight. Stuff doesn't happen like that. Trust me, I tried it at a very young age. I started trading when I was 18 years old. It took me about 15 years of spinning my wheels, having big gains, big losses, to realize I need to step back, detach, and take a look at what really needs to be done to grow wealth. And these are the points that we're about to go over now. So number one was you must get some type of source of income and use your income to build wealth. Okay. Number two, which we're going to jump over to TC2000. All right. So number two is ETFs are safer than single stocks. Okay. And the S&P 500 usually outperforms all fund managers. Okay. You can pick up The Intelligent Investor. If you haven't read that, that's where Warren Buffett gets that, mindset. Pick up, gotta change those because that's not everything in there. Anyway, you can find a ton of huge fund managers, not really huge fund managers, but just about anybody that will tell you just sticking to the S&P 500, you will do perfectly fine. So if you're dollar cost averaging in the S&P 500, meaning you're just buying every week, you're just buying every month, every other week, that is much safer than buying single stocks, because the S&P 500, which is SPY, this is an ETF, that is basically made of the top 500 stocks in the market. Okay, so it's hard to go wrong by investing in a basket of the top 500 stocks in the market. Okay, so for the passive investors that, if you just want to throw money in something and, do it every week, every month, every other week, whatever your pay is like, just buy SPY, buy VOO, which is Vanguard's S&P 500. I'm not a fan of Vanguard, but whatever. Even though they are cheap, but we'd have to dig into something else, which is the problem with 12. If you haven't read that book, that's another good one. But so very common sense. Point two, ETFs, way safer than single stocks. I think everybody would agree on that. It's just very basic common sense. Okay. If I own one single asset and that asset is diversified in 500 different stocks, the 500 best stocks in the stock market, that's way safer than owning any single stocks, which these are all. So these are the stocks in the S&P 500. You can go through, try to pick out the best, only hold the best. But if something happens in that one stock and that stock drops 10%, that's going to affect you way more than that stock dropping 10%. And the only thing you're holding is SPY. Okay. You may be holding that stock through SPY, but you don't actually have just, let's say, 10 or 20 stocks in your account. So for instance, I have multiple accounts. I have 3 custodial accounts. One account that I'm very, very passive on, where it's really compromised of SCHD, which is a little bit more dividend. HDV, really some dividend players. So I got income flowing into those, automatically investing in those. And then I do, if something comes up that looks good, I will add that position to that account. But anyway, enough of that. ETFs are going to be the safest bet. That's just what it is. Okay. Leverage. This is point 3. Leverage is a great tool to increase really anything. But when you're talking about finances, leverage is a great tool to help you build wealth even quicker. Now, you can find multiple sources that tell you that. Right? I'm not going to quote books on that or anything else, just kind of common sense. Now, there is a thing, and this is almost, that's the end of point 3. Leverage, great tool to increase wealth. Okay, and we're going to kind of jump that right into point 4 as well. Leverage ETFs give you leverage without borrowing money. Okay, I don't want to borrow money. I don't want to have a margin account. I want to use leveraged ETFs to help me leverage my gains. It's also going to impact you on losses as well. So if the market tanks and you're in a leverage ETF, that leveraged ETF is going to go down 3 times what the market's going to go down. So if SPY, what you got to understand, the market's at all-time highs. Look at the weekly chart, which is one reason last week we kind of locked in some losses. Really on my gut feeling. And we had plenty of profit. We've already hit our profit out till May. So anyway, we'll get back on topic. But if SPY has a 5% pullback, let's say it goes down to the 50, that's a 12% pullback. It's got plenty of room to pull back, ladies and gentlemen. That's an 8% pullback right there. Now, Quad X is a 4-time leverage. SPXL is a 3-time. But yeah, I mean, you're talking, let's say if SPY pulls back on the weekly to this support right there, that's going to be a little bit of support. 20-day moving average. Let's say it has an 8% pullback over the next month. That's 16. That's 24%. That ETF's going to be down, that leveraged ETF. So you want to be able to get in and use it very, very strategically. Okay. And that moves on to our next point. So point 5, the market swings up and down. Here until recently, the market has been, usually the market is always swinging up and down. Okay. Now, over the last 2.5 months, we really haven't sold off much. But if you go back and look in history, even on the weekly charts, you can kind of see, usually it's about a month to a month and a half, sometimes 2 months, sometimes where we are now, 2.5 months. But as you can see, it's not that long really to get an oversold condition. So that's point 5. The market swing up and down. Okay. And you'll see where I'm going with that here a little later if you can't guess already. And it's really just taking advantage of those swings. So we'll kind of, throw that out there now. But if you can take advantage and capitalize on those swings, I mean, there's been years where we had the Dow Jones, which I'm hoping this does this year, just swings up and down, bottom Bollinger Band to the top to the bottom. And those are years where you can just, crush it on the swings on the market. They don't always go up, straight up, and it's not going to go straight down, right? It's going to swing in one direction or the other or sideways. So the goal is to capitalize on those swings. Otherwise, just be a passive investor. But we'll jump back into that compound interest calculator and show you the difference between a passive investor and an active investor. Point number 6, never bet against America. Okay. You can be sitting on cash, but don't go short. That's pretty simple. Okay. Because shorting the market, I mean, you know how many people, so let's say I did try to swing both directions. Okay. You'd get your face murdered multiple times. Most people that short the market don't win. As you can see, the market's at all-time highs. The market is nothing I would short. All right, I don't like betting against America. I don't like the mind frame it puts you in. I'm not a fan of shorting the market. Point 7. So reading the stock charts, which goes back to the swings, are like reading investor psychology. Okay, so learn how to read a stock chart. That's the only way you're going to capitalize on these swings. It's that simple. 0.7 is that simple. All these points are that simple. And there's really not much else I have to touch on. You can see my chart is very, very clean. I have a 50-day moving average. I have a 200-day moving average. And I have stochastics. Okay, that's all I need. Now you can tell a lot by the candlesticks as well. And pay attention to all your time frames. Pay attention to the weekly time frame. Pay attention to the monthly time frame. Pay attention to the hourly. Now, obviously, the monthly you don't have to look at every day because it's every bar is a month. You get the point. So just pay attention to the time frames. Keep it simple. Don't overcomplicate it, but learn how to read a stock chart. And point 8, cash flow is key to managing positions. So basically, to keep your cost average low, you want to make sure you can enter probably about 4 to 5 more times. Because let's say you do enter a leverage ETF. Okay, let's say you enter, let's say here. So it was oversold here. I'm going back a little bit because we haven't really, it's been a rocket since January. So haven't really seen too many pullbacks to kind of give you an example. But okay, so let's say here. Let's say you enter, it's oversold here. You may have even bought here thinking it's going to rally back up. Okay. Let's go to SPY for this example, which looks a little different. So we want to see it hit the bottom Bollinger Band as well. That's so if that just hit oversold there, we would have definitely went in light there. But it dropped as much as 3% over the next 11 days. Okay. So your leveraged ETF would have dropped almost 10%. Okay, so keep that in mind. You've been down 10% from your other entry. And by the time it swung back up, that was very rare for something when it hits oversold to hit overbought again for you not to at least break even. But so you would have, let's say if you were able to average down 4 more times, okay, you probably would have bought. That was a good down day. So your average, without getting a calculator out and doing the math, if you would have been buying here, and bought more here, your average probably would have been right about there. By the time it got to the overbought position, you'd been up 2% on just SPY. But keep in mind, that's would have been, it's almost 3%. So you've been up roughly 8 to 9% on just that swing trade. So that would have took place of 27 days. That'd been about a month. That's our goal, right? 7 to 8% a month. So really, really simple. You must keep cash flow. So the question is, can you use these simple terms, simple points, and beat the market? Yes, and that's what we're doing and trying to show you with simplified profits, our transparent account. It's what we try to explain in the book and teach on the channel. So let's jump back over to that compound interest calculator, and I'll show you the difference between beating the market and not beating. So here we are, 84%, okay? Now, most people hope to get 10 to 12% a month after fees, and most people don't get that, okay? But let's just say you get 10% annually, which is what the market averages. That's a big difference, ladies and gentlemen. So you go from, and that's in a 10-year period. So if we were taking that same $2,000 and we were putting $1,400 a month in for 10 years, and we were averaging what the market averages, 10% a year. Let's even kick it up to 12. Heck, let's go to 12. You're going to be sitting on about $331, which isn't bad. It's not bad. I mean, you got over 10 years, you've put 170 in, and you're at 331. That's still good. But to me, even if I can, let's say I just beat the market's average by 2. Let's say right now we're at 25% on our transparent account, and it's only April. I believe personally we'll stay on the 7% average. Who knows? It could be less, but let's just say we just keep it at 24% by the end of the year. In 10 years, that's a big difference. Okay. It's obviously double what it was, and you can keep playing around with that. So even in 10 years, so right now I'm 41 years old. Let's say you're starting over at 40. Okay. And you're able to beat the market and get 40%, average 40% a year. Put in a 2000, start with 2000, put in 1400. You're going to end at 50, you'll be sitting on 2.2 mil. Let's say you can only put 700 in a month, still over a mil, just by 40%. That's way less that's half of what we're doing now. So you're averaging 3.5% a month almost. That's the power of compound interest. The reason why being a little bit more active to beat the market pays off, without trying to get rich overnight. A lot of people try to get rich overnight. Most of the time when people think of the stock market, what do they think of? All right, most people think of either passively investing or day traders that are out there trying to make a living, gambling basically, right? Trying to day trade options, stuff like that. You can keep it very, very simple, be a little bit more active than passive, and crush the market. And that's what we're trying to do here, and trying to show you with our transparent account based on the principles in the book and the 8 points we just went over. And that's it, ladies and gentlemen. I'll probably shoot a transparent account video probably next week. I don't have a lot of time tonight. Not in a rush. Right now, we're sitting all cash. We had income hit on Friday. We're up about 25% so far year to date. To hit our 7% goal, we need to be at 28%. Obviously, it's April. So we need about 3% more for the month, which I'm not sweating. I can easily get that. But one thing I am probably going to do, because we have broken a few rules in the book, but the book is really just to teach you the basics and the simplicity, how simple it can be. I'm a little bit more experienced in that, so I like, breaking a few rules here and there from the book, because usually it pays off. Once you start learning how to read stock charts, you'll understand what I'm talking about, especially once you learn how to keep it simple and have a goal set where you're not trying to get rich overnight, but maybe you're trying to build wealth over the next 5 to 10 years just by beating the market. And that's it. I'm out.